Hi everyone, my name is Simon Mishevich from Optimise Accountants, and in this video I'm going to give you six tax saving tips for inheritance tax planning. So let's get into that detail. So what is UK inheritance tax anyway? UK inheritance tax is a levy on the value of an estate exceeding £325,000. There are additional things that you could get, but we'll keep with the basics. Applied at a rate of 40% on anything above that threshold. Wow, a lot of money right there. This tax is meant to contribute towards government funding, but careful planning can help minimize the amount your loved ones owe when you inherit. So basically what we're looking at is to try and minimize inheritance tax. And you could do that whilst you're alive, and we'll talk about that in these tips. But before we do, let's look at an example here. This is a basic example, and we're going to look at a single person and a couple. And the reason for that is because IHT lifetime allowances are doubled as a couple. Whether you're husband, wife, civil partner, it is going to be increased by 2. So net assets, what did I put net assets for? Well, your inheritance tax is going to be based on net assets. So let's take a property for example. You might have a property of £750,000, but it's got a mortgage of £250,000, which means the net assets is £500,000. And it is that is subject to the £500,000, not the £750,000 gross limit. Now I'm going to avoid property for a second because I know there's some additional IHT lifetime allowances for residential nil rate bins. I'm going to ignore that for now. Just to keep this topic really basic. IHT lifetime allowance is £325,000 for a single person, and that is the amount of money you can give away to loved ones without suffering IHT. As a couple, that is doubled to £650,000. What's taxable then, as a single person, is the difference between £500,000 and £325,000 IHT lifetime allowance, which is £175,000. And as a couple, you can see there, it is doubled. The amount of tax that you pay, therefore, is 40% on the taxable amount. In this case, we're looking at £70,000 for a single person and £140,000 for a couple. So this is mistakes to avoid. These are tax plannings that I can give to you. Update your will. Once anything changes in your life, if you have a new business, you have a few properties under your name, you have a child, you have a stepchild, you get married, you go with a new partner, you get divorced, all of those matters means you should be updating your will. And you're probably thinking, but that's several wills I've got to do. Well, yes. But it's going to save you a lot of heartache and problems in the future. I've seen so many issues whereby one person passes away and the ex-wife, gets some money that they didn't intend. And that's because it was in their will previously. So that's a problem. Or they gave money to a stepchild that they no longer have contact with, no relationships with them at all. They're still getting money because they've not updated the will. So it's really important to do that, and do that, like I say, periodically when anything changes in your life. Update your pensions letter of wishes. Again, the big problem I've seen recently is that someone's passed away and their pension went to their ex-wife. That's right, their pension, rather than going to their current wife, went to their ex-wife because that person did not update their letter of wishes in their pensions. They said, well, they wouldn't have said anything, would they? But their mindset was they updated their will. Unfortunately, the will and a letter of wishes on pensions is different, and you have to do them separately. So make sure you do both. Plan with the family. Again, one of the things that you might see in this is children may not want certain assets. You might think, well, actually, I'm going to give this asset to my child. They will be grateful. Not always. So sometimes you might want to reconsider what you think other people might appreciate when you pass away. So plan with the family now, and they may surprise you with some ideas that will help you with legacy planning and inheritance tax planning as well. If you need to get some advice, feel free to use that QR code appearing on your screen. Okay, some other mistakes to avoid, some tips that I want to share with you. Make gifts within 7 years. If you know that you've got a finite period length of time, not everyone does, we know that, but if you know that you're in good shape, but you want to make some planning now, then you might want to give away some properties that you do not need the income from. You might have some assets like cars and art and so on like that, which you're happy to give as a wedding present, or you're happy to give to someone to say thank you. Those things, if you do those within 7 years, they will not form part of your estate, which means you will not pay inheritance tax on those assets, which is a great way of saving IHT. Value your assets. Unless you understand the current market value of your assets, you do not know the size of your inheritance tax problem. So if you've got properties, you've got art, you've got vintage cars, whatever it might be, make sure you have them valued at today's rate, because someone buying a property or a piece of art in the 1980s, they might be surprised because they think, well, hey, it's not going to be subject to IHT, the less than the IHT lifetime allowance bands. Maybe not true, because those assets may have grown in value and now exceed the IHT lifetime allowance, which means they've got an IHT band applied to them and an IHT liability upon your death. And the problem is sometimes with certain assets, you're not even able to sell them straight away on your death. So that person's got an IHT lifetime bill and an asset that's sitting there. They have to now go through the process of selling that asset, which can be quite stressful when they're trying to grieve for you. So again, do some planning, value your assets, understand the true problem that you have at hand. Investing in pensions, a big one. If you invest in your pensions, it will reduce income tax if you do it personally. If you have an investment in a pension from your limited company, it will help you reduce corporation tax. So this is not just an inheritance tax saving, this is an income and corporation tax saving strategy. Putting money into a pension that you designated to a beneficiary upon your death will therefore be subject to a 0% rate for IHT purposes, as in it is not going to be subject to IHT. So investing in pensions is a very good way of thinking about retirement planning, reducing income tax, reducing corporation tax and inheritance tax all at the same time.